Hello traders, welcome to a journey through the most powerful forces in options trading. Whether you're just starting out or looking to refine your strategy, understanding net Greeks is the key to unlocking consistent success. This presentation will transform how you view and build trades, helping you see beyond complex structures to the fundamental forces at work. Let's meet the Greeks, your options inner circle. Delta measures directional sensitivity to stock price movements. Higher delta means a stronger reaction to price changes. Gamma is the rate of change in delta, accelerating your gains or losses as price moves. Theta is the time decay factor, showing how much value your long option loses each day. Vega measures volatility, sensitivity, indicating how much your option responds to changes in implied volatility. Rho measures interest rate sensitivity but has minimal impact in most trading scenarios. So we'll focus on the four major Greeks. Every options trade, no matter how complex, is built on three fundamental components. Direction, represented by delta, reflects your outlook on where the stock price is headed. Time, represented by theta, shows how the passage of time affects your position. Volatility, represented by vega, indicates your expectation for price movement magnitude. These three factors are interconnected and always in motion. The most successful trades align with your forecast for all three elements. Here's the revelation that will change how you trade options. No matter how many legs your strategy has, it boils down to one set of net Greeks. That's your real trade. For example, a complex six-leg combo on Alibaba simplifies to a net delta, net theta, and net vega. You could likely achieve the same exposure with a simpler, more efficient structure. Don't chase complexity for its own sake. Simple structures often provide the same Greek profile with fewer transaction costs and less risk. Start by clarifying your market outlook. Are you bullish or bearish? That determines your delta. How much time do you need? That's theta. Is volatility rising or falling? That's vega. Match your Greeks to your view. Bullish means positive delta. Short term is theta friendly, and a volatility spike calls for positive vega. Confirm the combined effect of all legs creates your desired exposure. Calculate net Greeks, adjust if needed, and simplify where possible. The best trades align your forecast for direction, time, and volatility with your strategy's Greek profile. Delta and theta often work against each other in a classic trading tug-of-war. High delta positions, or directional bets, usually come with negative theta, meaning time decay costs you money. Neutral strategies, like iron condors or credit spreads, typically have low delta but positive theta, so time works for you. Pro tips. Buy in the money options to maximize delta relative to theta. Purchase more time than you need to reduce theta decay, and use spreads to offset some theta cost while maintaining directional exposure. Vega is the hardest Greek to forecast because it reflects human behavior, fear, and market sentiment. Black swan events, such as COVID or financial crises, can cause volatility spikes that overwhelm otherwise well-planned trades. To mitigate risk, choose Vega-neutral strategies when volatility forecasting is uncertain, hold until expiration when Vega becomes irrelevant, or use calendars and diagonals to benefit from volatility term structure. There are several tools for tracking volatility. ATR, or average true range, measures daily price movement magnitude and is great for assessing current volatility relative to historical patterns. The VIX index is a market-wide implied volatility measure known as the market's fear gauge. Comparing historical volatility to implied volatility helps determine if options are expensive or cheap. Moving averages on VIX, such as the 20 MA versus the 50 MA, identify volatility trends and potential reversals. When implied volatility is significantly higher than historical volatility, options may be overpriced, good for selling strategies. When implied volatility is lower than historical volatility, options might be undervalued, good for buying strategies. Let's put it all together with a real-world trade example. Consider a combo position entered at $3.10, with delta at 0.34, theta at -22, and vega at 20. If the stock rises $3 over 3 days and volatility increases by 5%, the theoretical final value is $4.46, a 43% gain. This illustrates the combined power of the Greeks. The delta effect is about $1.02 gain from the stock price increase, plus gamma acceleration. Theta results in approximately 66 cents loss from time decay, and vega adds about $1 gain as implied volatility increases. Once you realize that every trade is just a bundle of Greeks, your approach to options will change. You'll stop chasing complex combos and start building trades that actually match your market view. Keep strategies as simple as possible while achieving your desired Greek profile. Start with your market outlook and time frame, then build backward to sector, to underlying, to strategy. Focus on trades where you understand exactly how you'll make money. Remember, it's not about the structure. It's about the Greeks.